So imagine this for a second. Your income drops, but your tax bill, it goes way up. It sounds completely backward, right? But it's a harsh reality for so many surviving spouses. This is what's known as the survivor's tax penalty. And today, we are going to break down the exact math so you can see it, understand it, and prepare for it. All right, here's how we're going to tackle this. First, we'll get a crystal clear idea of what this penalty actually is. Then, we're going to unpack the triple whammy of tax hits a survivor has to deal with. We'll make it all real with 2 specific scenarios. Then, we'll get into 3 powerful ways you can prepare before it happens. And finally, we'll wrap up with the essential numbers you absolutely have to know. This is really the heart of the matter. For years, maybe decades, you've filed your taxes as married filing jointly. But after a spouse passes away, your filing status flips to single. And that one little word change on your tax form, it kicks off a massive domino effect, and it can seriously threaten your financial stability in ways you probably never expected. Yeah, it's not just one single problem. It's more like a 3-pronged attack on a survivor's finances, all happening at the same time. First, the tax brackets literally shrink, pushing more of your income into higher rates. Second, your standard deduction gets chopped nearly in half, which exposes more of your money to taxes. And third, that safety net for avoiding huge Medicare surcharges, it pretty much vanishes. Let's break down each one of these hits. Okay, look closely at this table, because this is so important. When you're married, you can see the tax brackets are pretty generous. They're wide. But as a single filer, they get cut almost in half. See that $85,000 income? For a married couple, it's sitting comfortably in the 12% bracket. But for the survivor, that exact same income gets slammed into the much, much higher 22% bracket. It's the same money, but a much bigger tax bite. Now think of the standard deduction as sort of a shield that protects a chunk of your income from being taxed at all. For a married couple over 65, that shield is worth $35,500. But for a survivor, that shield is shattered, shrinking down to just $18,150. All of a sudden, more than $17,000 that used to be totally safe is now fully exposed to the IRS. And this is the final blow. Medicare has these extra monthly charges called IRMAA. As a couple, you could earn up to $218,000 and completely avoid them. But as a single survivor, that limit is chopped exactly in half to $109,000. It is a brutal cliff. If you earn just $1 over that line, you can get hit with thousands in extra premiums every single year. Okay, let's put some real faces and real numbers to this. I want you to meet Mike and Linda. They're retired, and between their Social Security and some IRA withdrawals, they bring in a combined $104,000 a year. So while they're both together, their finances are pretty comfortable. They file their taxes jointly, and their federal tax bill is a really manageable $5,312. They're not worried about Medicare surcharges. Everything feels like it's under control. Now the unthinkable happens, and Mike passes away. Linda now starts getting Mike's larger Social Security check, but her own smaller one disappears. So her total income drops by $18,000, down to $86,000. You'd expect her tax bill to go down too, right? Nope. It jumps to $7,205. How is that even possible? Well, this slide lays out the brutal math of the survivor's penalty. You can see it right there. Linda's income is down over 17%, but her tax bill is up more than 35%. I mean, let that sink in for a minute. She is paying more in taxes on less money. It's the very definition of a financial trap. And if you thought that was bad, for higher income couples, the penalty is absolutely devastating. Let's look at a second scenario. Here, the survivor's income drops by $20,000, but their tax bill, it skyrockets by almost 60%. But wait, that's not all. Their new income of $125,000 throws them right over that Medicare cliff we talked about, adding another $1,100 in premiums. All told, the survivor's paying over $7,000 more per year, even though they have less income. There's also this sort of hidden penalty that's tied to Social Security. As a couple, a large portion of your benefits are tax-free until your income hits $44,000. But for a single survivor, that taxable threshold drops all the way down to just $34,000. And what this means is that a bigger chunk of their essential Social Security income is now getting lost to taxes. But here is the good news. This penalty is predictable, which means you can prepare for it. And there are 3 key strategies to think about. First, strategic Roth conversions. This is where you pay taxes on your retirement money now while you're in a lower joint tax bracket, so the survivor can withdraw it totally tax-free later on. Second, smart Social Security strategy. The higher earners should really consider delaying their benefits to maximize the survivor's future, more tax-efficient payment. And third, life insurance. A tax-free death benefit can replace that lost income without pushing the survivor into an even higher tax bracket. So let's leave you with a quick cheat sheet for a single survivor, looking at 2026 numbers. Just burn these three numbers into your memory. The standard deduction is $18,150. The Medicare income cliff is at $109,000. And the Social Security tax trap starts at just $34,000. These are the numbers that really define the new financial reality. In the end, this isn't about feelings or opinions. It's just the math. The survivor's penalty is a predictable, mathematical consequence of our tax laws. And because you can predict it, you can plan for it. The time to have this conversation and make a plan isn't in the middle of grief. It's now, while you still have the advantage of planning and filing your taxes together.